Great, thanks. So in this case, we're looking at group account, and we've said from the beginning that a group basically is composed of two things. Whenever we talk of a group of companies, we are looking at two things. We have the parent company and a subsidiary. Parent company and a subsidiary. And we're trying to explain something very important, that as we begin, this is how we shall be looking at what here is how we shall be looking at control. That if we have a company called P that owns more than 50% of another company called S, if we own more than 50% of this company S, then company S will become part of us, sub, like a subsystem. So company S becomes part of us. If we own more than 50% of your shares, more than 50% of your shares, then you become part of us. And if you become part of us, we shall be calling you a subsidiary. So this one here will be called who? A subsidiary. This one will be called a subsidiary, and the owner, the one that is now having more than 50% of this company, will be called as who? Will be called as a parent. Will be called a parent. Will be called who? Will be called a parent. Will be called a parent. So we have this concept of parent-subsidiary relationship. I would want you to understand me from the word go, that if I own more than 50% of a company, then it automatically means that I will be controlling the operations of this company. P will be controlling operations of the subsidiary. How? Because if we have more than 50% of your shares, normally the management of the subsidiary is put through an AGM, an annual general meeting at the end of the year. We have all the shareholders, the owners of these subsidiaries coming together, and then they make a decision like who will be the chairman of this particular subsidiary. The one who has majority shares, the majority shareholder automatically becomes who? The controller. He'll be able to select the chairman. He'll be able to elect even many other directors to great what year? To great directorship positions of this subsidiary. So generally, whenever you are the majority shareholder, you call the shots. You are in control. And if you're in control of a company, even if you don't own 100%, so long as you're in control of a company, then that company is your subsidiary. It becomes part of the group. And I would want us to get back here. I would want us to get back here for purpose of understanding. We are told here that if one company owns more than 50% of the ordinary shares of another company, this will usually give the first company control of the second company. The first company, what we are calling the parent company P, has enough voting power to appoint all the directors of the second company, called the subsidiary company. P is able to manage S as if it were merely a department of P, rather than a separate entity. In strict legal terms, P and the S will remain distinct. They're different. They're registered at the registrar of companies as different companies. But in economic substance sense, they can be regarded as a single unit. And this single unit of companies is what we shall be calling a group. Is what we shall be calling a group. Is what we shall be calling a group. Group concept. Group concept. Although from the legal point of view, every company is a separate entity. From the economic point of view, companies may not be separate. In particular, when one company owns enough shares in another company to have a majority of votes at that company's annual general meeting, the first company may appoint all the directors of and decide what dividend should be paid by the second company. This degree of control enables the first company to manage, listen here, this degree of control enables the first company to manage the trading activities and the future plans of the second company as if it were merely a department of the first company. International accounting standards recognize this situation and requires a parent company to produce consolidated financial statements showing the position and results of the whole group. Results of the whole group. Ladies and gentlemen, I would want to pause there and remind ourselves that it is the prerogative of the parent company to produce consolidated financial statements. So once in this case here, you are the parent, never expect the subsidiary to, we don't consolidate from the subsidiary's perspective. We always consolidate from the parent angle, from the parent level. So it is the parent that is required by International Financial Reporting Standards 10, Standard 3, or what we call business combinations. IFRS 3 talks about business combinations. IFRS 10 talks about consolidated financial what yesterday. So from those two standards, which we shall be writing later on, ladies and gentlemen, the parent company, if you are in control of a smaller company, then automatically you have to produce what we call consolidated financial statements, also what we shall be calling group accounts. I would want to pause there for a minute and ask whether we are together. Are we together? 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 Great, great, great. Thank you so much. Thank you so much. Thank you so much. Now, so group accounts. The key principle underlying group accounts is the need to reflect the economic substance of the relationship. And we are saying if P controls a subsidiary, then this entire thing circled here is what we call the group. But again, remember that P is an individual legal entity and S is an individual legal entity. But because P controls S, and therefore they form a single economic, because of the control, that we are able to get into S, that we as P are able to get into S, we are able to get into this subsidiary and help them manage their affairs. We are able to send directors here, right? And because now we are in control, then it can only be fair if we take the two as a single economic what here, as a single economic entity, Very important. The key thing is that there must be control in between, and there must be control in between. Great, great, great. So the single economic entity concept, the purpose of consolidated account is to present financial information about a parent undertaking and its subsidiary undertakings as a single economic unit. So we must present financial statements of the parent together with financial statements of subsidiaries as if the two are one thing, a single economic unit. Show the economic resources controlled by the group. Show the obligations of the group, and then show the results the group achieves with its resources. Business combinations consolidate the results and the net assets of group members so as to display the group's affairs as those of a single economic entity. As already mentioned, this conflicts with the strict legal position that each company is a distinct entity. Applying the single entity concept is a good example of the accounting principle of showing economic substance over the legal form. Legally, they are separate, but economically, they are one thing because of what here? Control. We're not writing any notes because I'll share this book with you immediately after this. Consolidated financial statements under the single economic entity. This is by far the most common form of group accounts. Consolidated financial statements are prepared by replacing the cost of investment with the individual assets and liabilities underlying that investment. If the subsidiary is only partly owned, all the assets and liabilities of the subsidiary are still consolidated, but the non-controlling shareholders' interest in those net assets is also presented. Kizungu kubwa, but there is really nothing there. Listen and listen to me very well. Assuming, ladies and gentlemen, that we have this company called P. P has what shareholding of S? 80%. You see, 80% is more than the 50%. 80% is more than the 50%. 80% is so huge. It signifies control. But you see, the fact is here that we are not holding 100% of S. We happen to be having some other shareholder. And this other shareholder is the one who has got what percentage? Somebody. The other shareholder, you know, it has to be 100%. The other shareholder has got what we call 20%. 20%. So the one who has this smaller percentage is the one who shall be having a special position. In Kenya here, for example, would have called him an opposition leader. He's not controlling the government, but he's putting the government in check, right? So the one who has got this smaller percentage, we shall be calling them who? Minority. The old standards, we used to call them minority interests. But nowadays, according to IFRS 10, we call them non-controlling interest. We call them non-controlling interest. So whenever we move ahead, you'll be able to see once we start tackling questions that the one who has got the parent is controlling, right? And then the other one, ladies and gentlemen, is what here is non-controlling. The other one is non-controlling. The one who has got fewer shares is non-controlling. I can see Paul raising up his hand, which is very healthy. Let me hear what Paul has to tell us, really. I think Paul has a problem with his mic. I wish somebody can type for him that he needs to get off the meeting and then he comes back to the meeting afresh. Because when I look from this side, I can see he doesn't have his microphone. That's why I know he has a sound problem. 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 You can't hear me. Great. The single economic unit concept focuses on the existence of the group as an economic unit rather than looking at only through the eyes of the dominant shareholder group. It concentrates on the resources controlled by the entity. That will mean that intra-group transactions that I told you must be eliminated. This will mean that intra-group transactions will need to be removed, meaning that no income, expenses, assets, or liabilities are included that have arisen from transactions between entities within the group. Ladies and gentlemen, please listen and listen to me very well. Please listen. I'm trying to lay the ground here. I'm trying to lay some great ground here. That if, for example, P does business with S, for example, at the end of the day, P says, hey, you know what? I sold goods worth 10 million to S. Then that sale is intra-group. This is business within the group. And anything that is intra-group must always be eliminated. Out of this sale, P will claim it has made a profit. If it makes a profit from members of the group, that profit will be termed as unrealized and it must be eliminated. For now, I don't want you to understand so much in terms of definitions, but the key thing that I would want you to pick here from this single economic entity principle, ladies and gentlemen, because we are one, we can only regard the business, to be genuine if that business is done through third parties. We sold from the group. S sold to Joshua, who is not a member here. P sold to Mary, who is not a member here. But when we do business between ourselves, for example, we transfer some receivables. We transfer, in this case, here, we have, for example, like internal receivables, internal payables. Then those shall be regarded as fake and they shall be deducted. They shall be eliminated. They shall be eliminated. Great. Group financial statement. I'm still laying the ground, really. We haven't started doing anything great. I'm still laying the foundation. We are told here group financial statement could be prepared in various ways. But in normal circumstances, the best way of showing the results of a group is to imagine that all the transactions of the group had been carried out by a single equivalent entity, and to prepare a statement of financial position, a statement of profit or loss, and a statement showing other comprehensive income for that entity. Such statements are called because we're putting them together. They are called consolidated financial statements. They are called consolidated financial statements. I'm still laying this ground that to consolidate is to put together. And we shall be putting together what and what? Financial statements of the parent and the subsidiaries. We shall be putting together the income statement of parent, subsidiary, lump them together. The financial, the statement of financial position of both companies, put them together, etc. There are 3 IFRS standards within the financial reporting syllabus relevant to preparation of consolidated financial statements. 3 of them. We have IFRS 3, business combination, that was revised in January 2008. We have IFRS 10, consolidated financial statement, which was issued in May 2011. We have International Accounting Standard 28, investment in associate and joint ventures. Each company in a group prepares its own accounting record and annual financial statements in the usual way. From the individual entity financial statement, now the parent shall be required to prepare consolidated financial statements. In addition to the above accounting standards dealing with preparation of consolidated financial statements, the International Accounting Standards Board, abbreviated as the IASB, has now issued IFRS 12, disclosure of interest in other entities. So then we shall start now straight away with definitions. I told you all that I've been making, ladies and gentlemen, was just a lot of noise to lay the ground, to lay the ground. Now, are we ready to start now with definitions? Are we ready to start learning? Are we ready to start learning? Are we ready to start learning? Because I was just laying the ground, telling you that to consolidate is to put together, Telling you what a parent is, what a subsidiary is. I can see Godfrey Mwangi saying, yes, now we're ready to start the class. Great, 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 great. So here we are. The good thing with this consolidation is that the bulk of your exam marks will come out of this. Actually, talk of 40%, 50% of your exam will come out of this, because you can't miss a great question of group financial statements and another question of group cash flows. Actually, the moment you understand this very well, trust you me, it's as good as having walked from a field far away. So this class is very important for you, Great. So, ladies and gentlemen, we are told here, definitions, IFRS 10, consolidated financial statement, uses the following definitions in its appendix A. A parent is an entity that controls one or more entities. So if you're controlling an entity or you're controlling many entities, then you will be a father. You will be a parent is an entity that controls one or more entities. Number 2, subsidiary. An entity that is controlled by another entity is known as who? Is known as, or rather, an entity that is controlled by another entity is known as a subsidiary. So, ladies and gentlemen, anytime they ask me to tell them anything to do with these definitions, I'll always remember the concept of my group, that it is P and S, and it can only be a parent, and this can only be a subsidiary if there is control, if there is a control. So they tell me to define what a parent is. I will tell them straight away that a parent is that company that controls others, other companies. It controls other companies known as who? Subsidiary. And a subsidiary now is this company that is being controlled, that is a puppet. It's told in this case here, go left, it goes left like that, right? By who? By the parent company. Then it will be very important for us also to understand what control is. We must understand what control is. We must understand what control is. So then, gentlemen, we are told here, control of an investee. An investor controls an investee when the investor is exposed or has rights to variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. But nothing. I would want to repeat this again, and then I go straight away to the next paragraph for us to be able to understand what control really is. We are told an investor controls an investee, an investee, an investee when the investor is exposed or has right to variable returns, to variable returns, to variable returns from its involvement with the investee, and has the ability to affect those returns through its power over the investee. I like this. Let's continue a little bit. The requirements for consolidated financial statement. IFRS 10 outlines the circumstances in which a group is required to prepare consolidated financial statements. Consolidated financial statements should be prepared when the parent company has got control over the subsidiary. For examination purposes, is usually established based on ownership of more than 50% of the voting power. Voting power is about ordinary share capital. Control is identified by IFRS 10, according to what we read here. Control is identified by IFRS 10 as the sole basis for consolidation, and it comprises 3 elements. And these 3 elements are the ones we shall be abbreviating as pair. Pair like this, as pair, the three things that must exist for us to say really that you are a controlling company S. If these 3 things do not appear there, then you are missing out on something. You don't have any control. You don't have any control. The first one is power. The first one is power. The first one is power. So we have here, the first one is power over the investee. Number 2, we have exposure to variable returns. Variable returns are the profits. You are exposed to the profits of the company. And then we have now, lastly, is the ability to use this power over the investee to affect the amount of investors' what here returns. I would want, ladies and gentlemen, here to be very, very understood. For us to talk of control, there are 3 things that must always exist. That this parent company must have power to run operations of this company, right? It must be exposed to profits. It must be exposed to profit. It must be exposed to profit. Listen, like the other day, we had Kenya Airways having so many issues. And it was given a big loan by who? By this syndicated. It was given a syndicated loan by 3 banks. So you see, the bank that gave money to Kenya Airways cannot now say that even if they are able to control, even if they've got powers, they can't say that now Kenya Airways is our subsidiary. Of course, they gave quite a huge money for the bonds, a lot of money. And they were able even to influence like management, etc. But you see, at the end of the day, these banks are getting interest, which is a fixed rate of return, right? They don't have any shares. The person who has got shares is the one who is exposed to profit. Variable, you know, profit keeps on varying. Profit keeps on varying. Interest is normally fixed. If it's 10%, it's 10% of the amount you lend, right? So the first thing is that, fine, these banks were able to really like influence who is the CEO, who is the chairman of the board. They were able to, but remember, they were not exposed to profit, right? So there must be exposure to variable what here? To variable returns, exposure to profit, exposure to variable returns. And then lastly, we have the concept of ability to use this power, for example, to increase the profit. So if you are a good parent, you should be able to know that this person is a good director. Once you put this good director there, then the profit here will will go up, so that you will have the concern to care for your subsidiary. If you're not caring for your subsidiaries, then automatically there is no parent-child relationship. For us to talk of consolidated group accounts being made, there must be the parent and the child. Mtoto wako hutaki kuona mtu akiguza mtoto wako. Mtoto wako hutaki kuona mtu akiguza mtoto wako. Unasikia vibaya ukianza kuona anachokozwa. Unasikia vibaya. Ukiwa mzazi, hata mimi nikiwa mzazi, kama sasa niko na msichana teenager, sasa ingine hatutaki watu wakaribia sana kwa nyumba. So in this case you must be having the powers. Powers unaambia mtoto, for example, ingawa ni mbaya, wewe kaa hata kwa nyumba. Right? Kuna exposure to variable returns. There must be exposure to variable returns, and you can only be said to have exposure to variable returns if you own some shares, if you own some ordinary shares, not preference shares, ordinary shares in this particular company. And then lastly, A, for ability to influence this variable, to use the power to, let me read this again in a way that all of us will be very comfortable. So you're saying here that control is identified by IFRS 10 as the sole basis for consolidation, and comprises the following three elements. We have here the power over the investee, exposure or rights to variable returns from its involvement with the investee, the ability to use its power over the investee to affect the amount of returns. IFRS 10 adopts a principle-based approach to determining whether or not control is exercised in a given situation, which may require the exercise of judgment. One outcome is that it should lead to more consistent judgments being made, with the consequence of greater comparability of financial reporting information. IFRS 10 states that investors should periodically consider whether control over an investee has been gained or lost, and goes on to consider that a range of circumstances may need to be considered when determining whether or not an investor has power over an investee, such as exercise of the majority of voting rights in the investee, contractual arrangements between investor and other parties holding less than 50% of the voting shares, with all other equity interests held by a numerically large, dispersed, and unconnected group. Potential voting rights, such as share options or convertible loans, may result in an investor gaining or losing control at some specific date. I would want to be very clear, because this is very confusing. And I've seen this being examined severally, not once, not twice. Listen. The company that I work for, is basically a group consolidation software company. And I know one of the problems we get whenever we get serious clients is defining the investee companies that this parent has. Where do they belong? Are they supposed to be associates? Are they supposed to be subsidiaries? This concept of control is something that disturbs the people outside there in practice. Even you as students, if you're not keen, it will disturb you, but not after you have been in my class. Because I would want to make this very clear. Listen and listen to me very well. This concept of control, listen. If, for example, here we are 61 people, accountants, and fortunately, all of us here are very rich. If, for example, we were to talk over a contribution, each one of us in this case here does a contribution of 10 million Kenya shillings. 10 million Kenya shillings. We have contributed 10 million Kenya shillings, 10 million. That means we will raise slightly over half a billion Kenya shillings. And then we run majestically. We go straight away to Nairobi Hospital and buy shares there. We buy shares there. You buy shares of Nairobi Hospital, assuming Nairobi Hospital is trading at the stock exchange. We buy like 80% of Nairobi Hospital. So we have accountants here who have bought 80% of Nairobi Hospital. But remember, all of us here who are accountants, we know for sure that there is no way we can run a hospital of this magnitude. This is so big. Then what we shall do is to come and negotiate Perhaps with these guys who have got 20%, perhaps these are doctors. We tell these doctors, we are giving you a contract. Run this hospital on our behalf. You will be the managers. You'll be the directors. So even if these guys have got a smaller percentage, but because of a contract that we have issued to them, they're the ones who are going to call shots in this hospital, then automatically they will be called controlling. They'll be called controlling. They're the ones in this case here now will be able to do what we call consolidation. Ourselves, we have got 80%, yes, but because of our inability, we don't have the power. We can't call this our subsidiary. We will have, in this case, here to surrender, right, our right to consolidate to this smaller party here. And the smaller party will have the right to consolidate. Why? Because in this case, ladies and gentlemen, they are well within the pair principle. But because we have given them a contract, they have the powers to influence this hospital, to manage the hospital, right? They're also exposed to variable returns because should we get, for example, some huge profit, 20% is there. So at least they are exposed. If they have zero ordinary shares, then we shall say they are not exposed. Here they have 20%. Yes, it's below 50%, but remember we have relinquished our right to them to govern this company, which now will be called a subsidiary because it is the one, it is that company which now is under their care. Every day they are reporting there, they're managing the policies, they're working with whatever there, right? And of course, they also have an interest to protect there. They don't want to make losses there because if they make losses, the ordinary shareholders get a hit. They won't be able to get any dividends, right? Right. So we have the concept here, the ability, of course, the ability here will be the ability to make use of the power that they have to earn more profit, Listen, I would want to share these again. Listen, I would want to share these again. 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 We are told here that IFRS 10 states that investors should periodically consider whether control over an investee has been gained or lost, and it goes on to consider that a range of circumstances may need to be considered when determining whether or not an investor has power over an investee. Whether or not an investor has power over an investee, such that exercise the majority of voting rights in an investee. You can only be said to have this power to exercise majority of voting rights if you have more than 50%. That is a default status. If you have more than 50%, that is the default status. And then number two, contractual arrangement between the investor, now this as arguably the parent, the one that would have been a parent company, and the other parties holding less than 50%, like the doctors who held 20% of the voting shares, with all other equity interests held by numerically large, dispersed, and unconnected water groups. So the thing is that we have contractually arranged with this person who should have been an uncontrolling interest, an uncontrolling investor, to take up our position. And then we have potential voting rights. I'll be explaining more about this. We're almost finishing this. We are told the exemption from preparation of group financials. Who is exempted? You could be having a subsidiary, but in some cases, we shall be able to do what here to exempt you. Who is exempted? A parent need not present consolidated financial statements if and only if, number one, the parent itself is a wholly owned subsidiary or a partially owned subsidiary, and its owners, including those not otherwise entitled to vote, have been informed about and do not object to the parent not preparing consolidated. This is very easy, ladies and gentlemen. Please listen here. There is no, you will start. There is no, you will start making consolidated financial statements if this is the arrangement. If this is the arrangement, so you are calling yourself a parent of this subsidiary, but again, yourself, you happen to be having another company that, in this case, here owns you. If a parent company has got a parent company on top, Then the parent company, which is on top, is the one that will consolidate. Listen, ladies and gentlemen, as we progress, this is what we shall be getting here. We shall be having here a parent company who has a subsidiary. And this subsidiary also owns some other company that we shall be calling a sub-subsidiary. But you see, this is apparent to this. But there is no way this can prepare consolidated financial statement because it's also an investment of another company on top. So if a parent company also has an owner on top, then automatically that parent cannot prepare group accounts. Let me repeat this again by reading this because this came like last semester. So we are told here, the parent itself is a wholly owned subsidiary or partially owned subsidiary. That's just enough. Stop reading any other thing. A parent need not present consolidated financial statements if and only if the parent itself is a wholly. So the moment in this case here, this that is calling itself a parent of this, if it's owned by this one, then automatically this cannot make group accounts, cannot make group accounts, cannot make group accounts, cannot make group accounts. From there, we are told here, the parent's debt or equity instruments are not traded in a public market, are not traded in a public market. The parent's debt or equity instruments are not traded in a public market. Ladies and gentlemen, if in this case here, you are a parent here, you are a parent here, and here, ladies and gentlemen, I would want to give a very practical example. Like ourselves here, we are known outside here for publishing, of course, CPA books. And that is why our very first company that we opened here was known as RCM Publishers. RCM Publishers. Now, if you go to the register of companies, we have been able to open a college here known as what? Another company known as the RCM Online College. It's limited. It's limited. So then, should we start making consolidated accounts? That will be hogwash. That will be stupidity of the highest order. Why? Because, ladies and gentlemen, this parent does not have its shares or debt instruments like bonds selling at the stock exchange. So if you have subsidiaries and yourself, in this case here, you are not having your shares trading at the stock exchange, then you are exempt from preparing consolidated financial statements. Are we together up to there? Are we together up to there? Are we together? Please respond. Please respond. Are we together? Are we together? Great. Thank you very much. Thank you very much. Now, ladies and gentlemen, from there, the parent did not file its financial statements with a Securities Commission or other regulatory organization for purposes of issuing any class or instruments in a public market. Now, ladies and gentlemen, please remember, if, for example, RCM Publishers here wants to raise capital at the stock exchange, we have what we call private placements, where we'll get NSC looking for a private investor. So then what do we do in that case? We'll have to prepare a prospectus, which we file with who? Which we file with who? Which we file with NSC, or Capital Markets Authority. Once you start, ladies and gentlemen, the process of raising anything publicly, then you shall be required to consolidate. You shall be required to consolidate. So you could be having RCM Publishers shares not trading at the stock. Of course, that exempts us. But what if, ladies and gentlemen, even if we are not trading our shares at the stock exchange, what if we have started the process of looking for capital from the stock, from the public up? The moment you go and file your financial statement at NSC for purposes of looking for capital from NSC investors, automatically you'll be required to consolidate. So listen, and this is something that is really well within my dreams. In future, I would want my college here, and of course, this publishing entity like Longon did, would want to get into public, raising capital from the either through shares or bonds. The moment you start that process and you have filed, you reach that stage where you file your prospectus with the stock exchange, then automatically you must consolidate, because now the republic, or rather the public, would want to know the group status. The group status. Would want to know the group status. Would want to know the group status. Great. So here we are, ladies and gentlemen. We are saying here the ultimate parent company produces consolidated financial statements that comply with the IFRS standard and are available for public use. For public use, the ultimate parent company produces consolidated financial statements that comply with the IFRS standards and are available for public use. I would want to explain this very well. So here you are. For example, you are this company, or even you are this company here. If in this case you are aware that you have some ultimate parent somewhere, some ultimate parent company somewhere that is producing financial statements, group consolidated financial statements, which of course are compliant with the IFRS, then you don't have to bother. You are exempted, even if you have your own children. So long as there is an ultimate parent company somewhere that is making this group account, then automatically you are what here? You are exempt. Automatically you are exempt. Those are 4 points, which in this case here gives you an exemption status, but I'm so sure we shall not be able to remember all of them. But I would want a good student to tell me only 2 points, when in this case here, this subsidiary, or rather when this parent company is exempt from producing consolidated financial statements. Could you just give me 2 points that you're able to record, because I'm so sure you weren't writing? Only 2 reasons that can make you to be exempted. Like Nimrod says, not listed with the NSC. Nimrod, I'm telling you, if we were together like this in some classroom, I would have given you 1,000 bob. You're a good student. I would have given you 1,000 bob straight away, but not because of distance, you know. Because of distance, you know, you can't get that gift. So I'm waiting. Use M-Pesa. If a parent has another, I like the way you guys are using your own language. If a parent has another parent, then automatically the ultimate parent that will produce consolidated financial statements. I like that. If there is an ultimate parent, automatically the ultimate parent is the one that will make financial statements. You, who is not an ultimate parent, you are exempt from producing when it's wholly owned by another parent. At least you guys have given me the ones that you shall be able to remember if you are asked here. Ladies and gentlemen, the second last thing for today. No, these are not really ours. We have these reasons for wanting to exclude a subsidiary. Why will directors want to exclude? Why would directors want to do creative accounting, what we call window dressing? You know, when you leave out a subsidiary that is doing very badly in terms of performance, that is cheating the public. That is what we call window dressing. The directors of a company may not wish to consolidate some subsidiaries due to poor performance of the subsidiary, poor financial position of the subsidiary, differing activities of the subsidiary from the rest of the group. These reasons are not permitted under IFRS standards. They're not permitted. They're not permitted. Now, ladies and gentlemen, what I would want to do is to take you straight away to an exam. And now here, I should be able to give a present. There are 4 questions. Anybody will be able to get these 4 questions correctly. They are multiple choice. We give them 500 shillings through M-Pesa. So you read and then you write your answers like 1A, 1, 2B, like that. So we start with the first one. Which of the following definitions is not included within the definition of control per IFRS 10? Having power over the investee, having exposure or rights to variable returns from its investment with the investee, having the majority of shares in the university. D, having the ability to use its power over the university to affect the amount of the investor's returns. So which one of the following is not included within the definition of control by IFRS standards? Please say one, whatever. And then we go to number 2. And then we see the one will be able to get all 4 correct. All 4 correct, we give them a reward. 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 Thank you very much. So then let's go to number 2 now straight away. Let's go to number 2 straight away. Number 2 straight away. Number 2 straight away. So number 2, which of the following situations is unlikely to represent control over an university? Unlikely to represent control over an university. Owning 55% and being able to elect 4 of the 7 directors. Owning 51%, but the Constitution requires that decisions need the unanimous consent of shareholders. C, having currently exercisable options, which would take the shareholding of the company to 55%. D, owning 40% of the shares, but having the majority of voting rights within the company. Which of the following situations is unlikely to represent control over an university? We shall mark, we shall mark, we shall mark, we shall mark together, 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 we shall mark together. Thank you very much. I can see 17 charts on the same, 500 gone. Which of the following is not a condition which must be met for the parent to be exempt from producing consolidated financial statements? Which of the following, you know, as you see, they ask things in the opposite way, right? Which of the following is not a condition which must be met for the parent to be exempt from producing consolidated financial statements? A, the activities of the subsidiary are significantly different to the rest of the group, and to consolidate them would prejudice the overall group position. B, the ultimate parent company produces consolidated financial statements that complies with the IFRS standard and are publicly available. C, the parent debt or equity instruments are not traded in a public market. D, lastly, the parent itself is a wholly owned subsidiary or a partially owned subsidiary whose owners do not object to the parent not producing consolidated financial statement. So please guess there. Give me the correct answer. Of course, you guys are not guessing. You're not guessing, of course. Give me the correct answer there. It's not a condition which must be met. Now I can see the answers are not coming as fast as the others were. So have they finished giving me the answer? Have they finished? Please ensure that you're writing your numbers. Ensure that you're writing. If you're not writing your numbers, you're disqualified. You must say, for example, like I'm seeing students saying there, 3A, 3A, 3A. And then 4, which of the following statements regarding consolidated financial statements is correct? Correct. For consolidation, it may be acceptable to use financial statements of the subsidiary if the year end differs from the parent by 2 months. For consolidation, all companies within the group must have the same year end. Unfortunately, we skipped the coterminous years, but let's see somebody who is lucky. All companies within a group must have the same accounting policy in the individual financial statements. D, only 100% subsidiaries need to be consolidated. Which of the following statements regarding consolidated financial statements is correct? Great, great. So now we shall go to the marking straight away. We see who is lucky and who was the first one to get all these answers right. Let's see, let's see, let's see. So here are the answers. Here are the answers. We have the chapter summary. Here are the answers. So question number 1 is C. While having the majority of shares may be a situation which leads to control, it does not feature in the definition of control per IFRS 10. Because under IFRS 10, it is pair principle. Pair principle. Power, exposure to the profit, and ability to use that power to influence the profit. 2 is B. The fact that unanimous consent is required would suggest that there is no control over the university. You have got 51%. But because it's 100% who have to agree, then you will not be able to control this thing yourself. You need the other guys on board. Then we go to 3A. The activities of the subsidiary are irrelevant when making the decision as to whether to produce consolidated financial statements or not. Even if you're a school, running in this case here, for example, ladies and gentlemen, a butchery. So long as this butchery are able to control it, automatically then you need to consolidate. And then we have 4A. IFRS 10 states that where the reporting date for a parent is different from that of a subsidiary, the subsidiary should prepare additional financial information as of the same date as the financial statements of the parent, unless it's impracticable to do so. If it is impracticable to do so, IFRS 10 allows use of subsidiary financial statements made up to a date of not more than 3 months, earlier or later than the parent's reporting date, with due adjustment for significant transactions or other events between the dates. The companies do not have to have the same policies in the individual financial statements, but adjustments will be made to prepare the consolidated financial statement using the group policies. All subsidiaries need not to be consolidated, not just 100% owned subsidiaries. You don't have to consolidate, or we have those exemptions to remember. So now I would want to know who was the first student to get all 4. And please don't cheat. Please don't cheat. Tell us in this case here, who was the first student to get all the 4. Please don't cheat, because we'll go back. We'll go back up there. We'll go back up there. We'll go back up there. So if you know that you got all the answers correct, say me, and then I'll be able to direct what next is to be done. What next is to be done? What next is to be done? It's like there is nobody who got all 4 correct. It's like there is nobody who got all 4. All 4. It's like there is nobody. You know, the good thing is that we have evidence. We have evidence up there. 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 Is there anybody really? Be very honest, Peter. Is there anybody really who got the 4 of them? Be very honest. Be very honest, because accountants must go to heaven. Accountants must go to heaven. Accountants must go to heaven. So is there somebody who is able to confirm for me whether Peter, whether I'll do that, Savula. I would want to see, Imeenda. So was Peter able to get those 4? Perhaps what we could do, because Peter is the only one who has taken in this case here that initiative of saying yes, hata kama ametudanganya, tupatie namba, tupatie lunch Peter. Tumalize hii case namna hiyo, tupatie namba ya simu hapo. Tupatie, got all the answers correct, except that I did number question 1. Great. Confidence helps.